Every time the US debt ceiling hits the news, we hear numbers so big they're almost meaningless. Trillions of dollars. But what does the US national debt actually mean for your wallet, your investments, and the economy? Today, I'll explain what the US national debt really is, how debt can lead to inflation, deflation, or stagflation, and which ETF investment sectors historically perform better in each environment. Watch the full video, where I'll break down the investment strategy I use to stay resilient across economic cycles, all kept simple, visual, and practical. The U.S. national debt is the total amount of money the federal government owes to creditors. That includes U.S. Treasury bonds owned by investors, debt owed to foreign governments, pension fund obligations, the Federal Reserve balance sheet, and even U.S. government agencies like Social Security. When the government spends more than it collects in taxes, it runs a budget deficit. Deficits add up over time, and that accumulation becomes the national debt. Key point to remember: when tax revenue falls short of government spending, the gap is filled through borrowing. And that borrowing takes the form of treasury bonds sold to investors. Over time, repeated deficits turn small gaps into large national debt. When interest payments on the national debt grow so large that they become the economy's primary expense, the country has entered a debt spiral. A debt spiral is bad because it becomes self-reinforcing and increasingly limits an economy's ability to function, invest, and respond to problems. Once it starts, each attempt to manage the debt tends to make it worse rather than better. Important point: debt itself is not automatically bad. The United States has carried debt since 1790. The real risk isn't the existence of debt, but how quickly it grows relative to the economy and how that debt is financed. Historically, when empires accumulated debt levels they could no longer sustainably support, it led to weakening economic foundations, reduced policy flexibility, and a gradual loss of global influence. These historical patterns have been studied extensively by Ray Dalio and are a key reason he developed the all-weather portfolio, a strategy designed to remain resilient across inflationary, deflationary, and stagflationary environments. Quick disclaimer: this content is for educational and entertainment purposes only and should not be considered investment, legal, or tax advice. The information presented is general in nature and may not be appropriate for your individual circumstances. Always conduct your own research and consult a certified financial planner, tax professional, or legal advisor before making financial decisions. Let's start with the scenario most people worry about: inflation. Inflation mechanism. Inflation occurs when government borrowing grows rapidly, the Federal Reserve purchases debt, new money enters the economy, too many dollars chase too few goods. If debt expansion is paired with aggressive stimulus and low interest rates, money supply rises faster than productivity, and prices climb. Examples of inflation triggers: large fiscal stimulus packages, war spending, expansionary monetary policy, debt financed indirectly by money creation. ETF sectors that often perform better during inflation. In inflationary environments, investors often look for assets that can pass higher costs on to customers. Common inflation-resistant ETF sectors. Energy ETFs, oil, gas, pipelines. Examples include VDE, Vanguard Energy ETF, XLE, Energy Select Sector SPDR Fund, IXC, iShares Global Energy ETF, Materials ETFs, metals, mining, chemicals. Examples include XLB, Materials Select Sector SPDR ETF, VAW, Vanguard Materials ETF, FMAT, Fidelity MSCI Materials Index ETF. Commodity ETFs. Broad inflation hedges. Examples include PDBC, Invesco Optimum Yield Diversified Commodity Strategy ETF. COM, Direction Auspice Broad Commodity Strategy ETF. COMT, iShares GSCI Commodity Dynamic Roll Strategy ETF. Real Asset and Infrastructure ETFs. Examples include IGF, iShares Global Infrastructure ETF. INFL, Horizon Kinetics Inflation Beneficiaries ETF. RAAX, VanEck Real Assets ETF. TIPS Focused Bond ETFs. Examples include TIP, iShares TIPS Bond ETF. SCHP, Schwab US TIPS ETF. VTIP, Vanguard Short-Term Inflation Protected Securities ETF. Why do these ETFs win during inflation? Because inflation rewards real assets and companies with the power to raise prices. Now let's flip the script. Debt can also cause deflation. Deflation mechanism. Deflation happens when debt levels become too high. Borrowers reduce spending to service debt. Credit creation slows. Money circulation collapses. This is often called a debt deflation spiral. Households, companies, and governments stop spending because they're too leveraged. Prices fall, not because goods are abundant, but because demand dries up. ETF sectors that often perform better during deflation. In deflation, safety and cash flow matter more than growth. Deflation-resilient ETF sectors. Long-duration Treasury bond ETFs. Examples include TLT, iShares 20-plus year Treasury bond, VGLT, Vanguard Long-Term Treasury, Utilities ETFs. Examples include XLU, Utilities Select Sector SPDR, Consumer Staples ETFs. Examples include XLP, Consumer Staples Select Sector SPDR, SCHD, Schwab U.S. Dividend Equity, Minimum Volatility Equity ETFs. Examples include USMV, iShares MSCI USA, Min Vol Factor ETF. VFMV, Vanguard U.S. Minimum Volatility ETF. Healthcare ETFs. Examples include XLV, Healthcare Select Sector SPDR, VHT, Vanguard Healthcare. In deflation, stability wins, cash grows stronger, safe income shines, and capital preservation becomes the ultimate edge. Now for the toughest environment of all, stagflation. What is stagflation? Stagflation combines high inflation, slow or negative economic growth, rising unemployment. This can happen when debt grows, productivity stagnates, and supply shocks raise prices, while economic growth stays weak. Why it's dangerous. Inflation hurts consumers. Slow growth hurts earnings. Traditional stock-bond diversification often fails. ETF sectors that historically perform better in stagflation. Stagflation requires assets that can resist inflation without relying on strong growth. Common stagflation-resistant ETF sectors: energy ETFs, commodity ETFs, gold-focused ETFs, managed futures or trend-following ETFs, low-debt, high-cash flow equity ETFs. In stagflation, flexibility beats optimism because the economy rewards adaptability, not hope. Now, let's take a look at my personal two-sleeve ETF hedge. When you zoom out, my approach isn't about guessing which economic outcome wins. It's about staying financially stable no matter which one shows up. That's why I structure my portfolio around two core sleeves, a stability sleeve and a real asset sleeve. The combined stability and real asset sleeves are 20% to 40% of my portfolio. The sleeve percentage increases as I get closer to retirement. Stability sleeve, protecting capital and liquidity. Investment percentages are based upon the funding allocated to each sleeve. My stability sleeve is designed to do one primary job: protect capital and preserve liquidity, especially during uncertainty. Ultra Short Treasury Core, 55% SGOV, 30%, BILS, 25%. This is the foundation. Ultra Short Treasury ETFs provide near-zero volatility, daily liquidity, and direct exposure to U.S. government backing. I'm not chasing returns here. I'm protecting optionality. Ultra Short Active Credit, 30% PULS, 10%, JAAA, 20%. This layer adds what I call cash plus yield. These funds are actively managed, focus on high-quality short-duration credit, and aim to generate income without taking on long-term interest rate risk. Short-term bonds, 15% VGSH, 15%. This slice adds a bit more stability and yield without sacrificing flexibility. Short-term treasuries historically hold up better than longer-duration bonds during rate volatility. Together, this sleeve behaves like financial shock absorbers, stable, liquid, and ready to be redeployed when opportunities appear. Investment percentages are based upon the funding allocated to each sleeve. The second half of my hedge focuses on a different risk: loss of purchasing power. Broad commodities, 40% COMT. Broad commodities provide diversified exposure to energy, metals, and agriculture, assets that tend to benefit when inflation accelerates. Gold, 25% GLDM. Gold plays a unique role. It's not about growth, it's about monetary hedging. Historically, gold has helped protect against currency debasement and systemic stress. Industrial metals, 25% XME. This adds targeted exposure to materials tied to infrastructure, energy transition, and industrial demand, especially useful in inflationary or supply-constrained environments. Short-term TIPS, 10%, VTIP. TIPS adjust with inflation, and by keeping duration short, this allocation helps hedge rising prices without excessive interest rate sensitivity. This sleeve isn't about speculation, it's about ensuring your money keeps its real-world buying power. When you combine stability with real assets, you're not betting on inflation, deflation, or stagflation. You're building resilience, and that's how long-term investors stay in the game. Remember, the game is not solely about accumulation, it's also about wealth preservation. The U.S. national debt doesn't guarantee inflation, deflation, or stagflation, but it raises the probability of all three, depending on policy choices and economic conditions. Key takeaways: inflation favors real assets and pricing power. Deflation favors bonds and defensive income. Stagflation favors commodities, energy, and flexibility. The future isn't certain, but positioning across multiple economic regimes can reduce risk and increase resilience. If you found this video helpful, share, like, subscribe, and let me know in the comments which economic scenario concerns you the most. And if you want a deeper, step-by-step framework for building real wealth, check out my book, The Wealth Basics, a practical guide to investing and building generational wealth, the stuff we should have learned in high school. It's available now on Amazon. Link is in the description. Thank you for your support, and I'll see you in the next video.